Money Sense, bringing an informed financial perspective to the Cayman community.
All right, good morning. Welcome to Money Sense.
Yeah.
This is Adam Butler. I'm hosting today, replacing, or at least attempting to replace, Simon Caudry, and on behalf of the CFA Society. And I have as my guest today my business partner at Resolve Asset Management, Mike Philbrick. Mike, welcome to the show.
Yeah, good morning. What a traffic day.
It was quite a mission getting here, I guess.
Our audience should be absolutely huge.
Yeah, that's true. Yeah, I'm sure there's a lot of people sitting in the car this morning.
Got in the car. We will be subjected to our financial advice.
Exactly. In case you didn't realize it, the highway is closed by the CIS Camana Bay roundabout, and I think it might also be closed by ALT. So be aware that the traffic is different this morning.
Yeah, but settle in.
That's right. That's right. So I guess we better get started because we are behind today by about 10 minutes. So today I wanted to talk about a paper that was recently published by the Federal Reserve Bank of St. Louis. It was published by a gentleman named Charles Calamares, and it's about the concept of inflation and the inflationary period that lies ahead of us, and we're going to get into why there's a strong probability that that's the case, and then the different ways that governments have at their disposal to deal with or address this inflation, and what that impact might be on you and I as people living in the world and in the economy. And of course, it's especially important to understand what's happening in terms of U.S. Inflation and U.S. fiscal and monetary policy. Is the U.S. government taking on large budget deficits? What is the Federal Reserve doing to accommodate those budget deficits? What is that likely to do with the currency and the cost of living?
Yeah.
And that impacts, because the U.S. is the global reserve currency, it impacts everybody.
Yeah, Noah Weisberger over at PGIM has 3 papers out talking about the impact of inflation on your stock bond portfolio. Obviously, it bleeds into your lifestyle too. But he actually went through the course of saying, well, is it a local phenomenon, this inflation, or is it stemming from the reserve currency? And it turns out about 70% of the influence for all countries is stemming from the reserve currency, which is the US dollar. So incredibly important to understand what's happening in US dynamics in order to see the waterfall into the other dynamics that you might be in another economy that's not the U.S. economy.
Yeah, it's a really good point. One of the factors that leads the U.S. dollars or the U.S. economy's inflation situation to impact the rest of the world is that all of the global commodities are priced in U.S. dollars. And what's generally not recognized is that the cost of energy flows through into all of the goods and services that are provided, not just in the U.S., obviously, but everywhere in the world. So as the cost of energy, especially, and not just energy, other materials, but energy has a disproportionately large impact. As the cost of energy rises in U.S. dollar terms, that impacts the cost of living everywhere.
And in particular, when energy is abundant, you face less of those types of inflationary pressures and bleedovers. When energy becomes more scarce, whether that's through looking through the lens of the metals that might go into batteries and all of these types of input prices, as well as oil and natural gas, when it's more scarce, it has a much larger impact on the inflationary impulse and is harder to control. I mean, the fact that you only have a certain amount of oil or natural gas that can flow from places on the earth to other places on the earth, and it will all be burned.
Right.
Absolutely. So shortages in one area or excesses in one area do get transferred. This is fungible. And so there's a lot there to unpack. And then it bleeds into, what am I going to do for my portfolio? You know, I would argue, and we argued, or not argued, we posited that peak 60-40 was probably at the end of 2022. That the idea of the portfolio that's 60% bonds and 40% stocks. and 60% stocks, 40% bonds, and that 40% bonds is the sort of the sea anchor that stabilizes the portfolio in times of economic growth, which is if it's scarce, right? If you have a growth shock. But if we go through history, there's 4 periods where that 60-40 portfolio had 0 real rates of return. There were 1898 to 1920, 1935 to 1945, 1960 to 1981, 1997 to 2008, maybe.
Right.
Those are time periods where that particular portfolio struggled mightily because, one, inflation causes bonds and stocks to be correlated. So now you have these two things that where you thought you had 2 pistons, you only have 1 piston. And the other, the real rate of returns on bonds is actually 0. So you're not getting the real rate of return, you're not getting the carry or the drift, and you're not getting the negative correlation. And
right.
The 70s is sort of very famous for that, a very recent example where it can be observed quite readily that the efficient frontier is just a straight line.
Yeah.
So those are portfolio implications, but lots of other stuff to dig in on the macro side too.
Yeah,
so
yeah,
back
yeah.
over to you to.
Well, yeah, no, I mean, what I wanted to sort of get across too today is why are we having this inflation surge, right? Because I think it's still a bit of a mystery, and I know it's still a mystery at the level of fine detail for even macroeconomists, but I think it's worth understanding for regular folks as well. Like, what are the major drivers of inflation, especially in the modern context? Because it's the drivers of inflation in this cycle are probably a little bit different than what drove inflation in the 1970s. The 1970s, we had a major demographic surge of the baby boomers entering the workforce, and that commensurate rise in demand for everything. And we had a huge oil shock and political conflict, and so there was a supply scarcity in the energy markets, et cetera. Today, what's happened is because of COVID, we had a lockdown and an effective cease of global trade, which meant that governments, in order to replace income, funneled money directly into people's bank accounts. So everybody was flush at the bank. They wanted to spend, but the goods and services that they would normally spend on were scarce.
Yeah.
And so you've got too much money chasing too few goods. And of course, that's the perfect dynamic for a price increase in all goods and services. Right. And that is, in fact, what we observed. So the general case here is that when the government runs deficits, for example, in the current fiscal year, the U.S. government's expected to run a deficit of about 6% of GDP. Now that sounds scary, and in some ways it is, but it's important to also recognize that when the government runs a 6% deficit relative to GDP, that 6% is moved from the government balance sheet to the balance sheet of the private sector, right? So government dis-savings is the private sector's savings. So in fact, what they've done is they've moved 6% of GDP into the private sector that can either be saved or spent. And much of it, because of the U.S.'s propensity to spend if there's money in the bank, much of that has been spent. And there's still a lot of excess savings in the bank, especially among middle and upper class earners who were able to live on their income, didn't need to draw on that excess savings in order to preserve their lifestyle. And that's why you're especially seeing excess demand in areas like travel, elective surgeries. A lot of the sustained inflation that we're seeing over the last 6 to 8 months has moved from kind of the goods sector to the services sector. And that's because typically those at the lower end of the income spectrum consume sort of fundamental goods for living. And once you sort of climb the income ladder, you typically end up consuming more discretionary services, right? And so it's the discretionary services area that is especially seeing sustained rises in prices.
Yeah. So if you think the aggregate demand shock, right? So you had this increase in aggregate demand because of the money flow, went to goods first. We were locked down. I couldn't do the services side. Mm-hmm. Now it's flowed into the services side. So you see this sort of persistent aggregate demand in a number of areas. On the supply side, you had those supply shocks creating shortages and things like that, creating some price instabilities and whatnot. What's also really interesting at this point in time, so a lot of money was flushed in to sort of dissuade the recession, if you will, of 2020 from COVID. So generally, if you have this increase in unemployment, and you're trying as a central bank and government to put more money into the system to, sort of soften the blow, if you will, of that. So that was done, but it was done with a bazooka. Mm-hmm. And now we are suffering some of the consequences of that as the inflation now flows through. And they've continued this fiscal spend, in a number of different areas, and they keep making excuses. They, being the U.S. government, keeps making excuses to continue this fiscal spend. You mentioned this at the outset, 6% government deficit at a moment when unemployment is at the lowest level it's been in 50 years. Mm-hmm. That's not the way it's supposed to work. What's supposed to happen is unemployment is supposed to be high, then the government runs deficits. Now we find ourselves in this precarious place where, first of all, we have these high deficits, we have very low unemployment. What's going to happen when we do enter a recession? Let's not predict about when a recession is, just know that there will be one in the future at some point.
Right.
And you're already running these massive budget deficits. You're supposed to be in a position where unemployment's low, the economy's doing well, and your deficits are low in order to save that power for the other times. And then, as you point out, the government's cost of borrowing, the government's spending goes into the economy. And we're in this very strange situation, which we haven't been in for a long time. So the 70s, 30% debt to GDP. You increase interest rates to slow the economy, but you only got 30% debt to GDP. So the increase in rates that's being pushed into the economy, that's stimulus.
Yeah, so let's unpack that,
Yeah.
right? So where Mike is going there, just to sort of repeat, is when government debt as a percentage of the size of the economy is relatively low, keep in mind, how does the government fund deficits? Well, it goes out to the market to borrow the funds. When it does that, it issues bonds. Those bonds pay interest. And that's why the people in the private sector, like pensions and insurance companies, et cetera, buy those bonds, right? They want to earn income from the government, safe income from the government. And when deficits are low, yeah, they're issuing bonds at a high interest rate, but the total outstanding amount of bonds is low relative to the size of the economy. So the interest payments on that debt that's issued don't have a very large impact, right? On the other hand, when the size of the debt relative to the economy is large, at the moment it's approaching 100% GDP. So it's over 3 times larger relative to where it was in the 70s. When they raise the rate of interest on that debt issuance, all of a sudden the interest payments on that debt start to have a major impact and become stimulative in the economy on their own. Every interest payment is excess savings for the private sector. And so we're trying in many ways to run the same playbook. The Federal Reserve and global central banks are in many ways trying to run the same playbook to fight inflation as they ran in the 1970s, but the context today is extremely different. Yeah. Keep in mind, let's run through why do we expect the Federal Reserve increasing interest rates, or the federal funds rate? Why do we expect that typically to slow the economy and raise the level of unemployment?
Right. So when you think about that through the lens of aggregate demand, right? So you raise the cost of doing business, basically, right? What is the hurdle rate now today to start a business? You're going to start a business, widgets. Okay, you got to go get a loan at the bank. That loan used to be at 1 or 2 or 3%. It's now at 7 or 8 or 9%. Well, that is a higher hurdle rate for that business. So just generally, it slows the economy. Now, when the economy, GDP, is 3 times larger than the amount of debt, by slowing the economy and giving these people who own the 30% of the debt a couple of shekels, it has a cumulative slowing effect potentially. And then you've got the stack of asset owners, whether they're likely to spend or not. So there's a lot of things that are at play here. So it's not quite as clear as we might be making it, but let's set that aside for the moment. So now you have an economy where there's 100% debt, and then there's this GDP, this economy, and you're raising rates to try and slow down the GDP, to try and slow down the amount of business that's being done, the amount of new business, new orders, all the fun stuff that's going on, trying to make it harder for people to get credit, personal consumption, try to get that lower. Meanwhile, everyone's cashed up and has a bunch of cash in the bank anyway. And on the other side of that, all of that debt that you have now is not paying everybody 1%, it's paying 5%. The retirees, the baby boomers, this is a boon for them. They're now locking in rates at 5 or 6%. Their income has just gone up by 5 times. Yeah. Now, how much are they going to consume versus in the higher wealth you have, the less likely you are to consume that. So there's other confounding factors there. But generally, you're at this initial conditions where the playbook that you've had and run in the past 4 decades is not quite as effective. And if you go back through time and look from 82 to the bottoming at 0, each effective, hey, let's slow the economy and raise rates, great. In order to stimulate the economy further, we had to get to a new low in rates every time for 40 years. Then we hit the 0 bound. And now we're in that other side of that. Mm-hmm. It's hard to envision with the idea of nearshoring or reshoring, the transition of the types of employees we have. It's hard to envision that we're going to have that persistent disinflation return. Maybe it does. Maybe we get into one of those deflationary type spirals because the debt is there. I'm not sure. Like this is one of those scenarios where the outcome is going to be interesting to observe.
Well, that's why this paper is so timely and important, I think, because they draw on not just data from the budget office of the Treasury, which makes forecasts about where the deficits and the debt is likely to be over the next, well, actually they make a forecast all the way out to 2397 in this paper, but other areas of data, and make a very strong case for the fact that entitlements, so Social Security and Medicare, et cetera, will run out, or we will no longer be able to sustain payments to those by 2034. So that's 11 years from now. And in the meantime, the government is projected to run deficits between 70% of GDP for the next 10 years. And again, when the government's running deficits, that's stimulating the economy and therefore raising the likelihood that demand is going to outstrip supply and that inflation is going to run hot.
Yeah.
So that likely means higher interest rates for as far as the eye can see. And the question then becomes, to your point, if we have a large amount of debt outstanding, the interest payments on that debt are large enough to be stimulative to the economy, then we're in this feedback cycle where raising rates, which is the only tool in the toolbox that the Federal Reserve has in order to try to slow the economy, begins to work against them.
Precisely.
And so then it becomes a question of, well, eventually bondholders are not going to be willing to buy those bonds at the rates that the government are able to pay in order to sustain the level of spending that they've promised. Yeah. And this is when we approach this situation of something called fiscal dominance, where instead of the Federal Reserve trying to act in general in alignment with its mandate, keep in mind the Federal Reserve has a dual mandate to preserve the value of the currency and to optimize the level of employment, right? When the government runs up against the point where the bond market, so the general normal participants in the bond market, are no longer willing to buy the government's bonds because they're not getting a rate of interest that will compensate them for the rate of inflation, then the Federal Reserve now needs to step in and buy the bonds that the private sector won't buy. And it sounds like, oh, well, if the Federal Reserve can just print money in order to buy those bonds, then what are we concerned about? But that, of course, is where the most insidious type of tax comes in, this idea of the inflation tax, right? And the inflation tax is one of only 2 types of tax that the government can enact without changing the laws or without having to reach a consensus in Washington to raise the general tax level on households or on corporations, et cetera, right? So because it's so easy, they don't need to change laws and they don't need to reach an economic consensus. This usually ends up being the default.
Yeah.
Historically, if you go back, we see episode after episode of governments largely allowing inflation to do the heavy lifting because they don't have the consensus politically to make other choices, right? So this is sort of the implication that we all need to be prepared for.
Yeah, I think you've succinctly captured that. And if you think through the idea that inflation runs a little bit higher than normal, 3 versus 2, and then you have to put on some sort of premium for duration on a 30-year bond. So, at the moment, you would, if it's 3 and you want 2 extra for the duration, that's a 5% 30-year. That's not where we are today. And this idea of higher for longer, that has pretty significant negative implications for bonds, even in spite of what's happening with a growth shock or a positive growth outcome. So again, coming back to implications to a portfolio that you have, that bond portfolio is not going to be the thing that it's been over the last 40 years as this diversifier. So investors are going to have to look for other diversifiers, global macro, CTAs, trend followers. In the portfolio context, in their own personal context, well, I mean, the nice thing is that you have higher rates on shorter term interest vehicles now that you can invest in. Take a little bit of the risk down in the portfolio and hope to offset that.
Yeah, absolutely. Wish we had time this morning to go into how to react to this coming dynamic, but we'll have to leave that for another show, I think.
Well, the one last thing I'll add is remember Einstein. One of the greatest invention was compound interest. This is what's working against the Fed at the moment.
Yeah, that's right. That's right. Well, I'll keep going until we get the sign that we need to shut it down. I thought we'd gotten that signal, but I guess we didn't.
Everyone's caught in traffic. They're loving.
Yeah, that's right. So, so if we're going to have a sustained inflation environment, as you say, bonds are mechanically going to suffer. The question, I think, in everyone's minds is what's likely to happen to real estate and what's likely to happen to equities. And there's been some really great historical studies of how the returns to equities are impacted by inflationary environments. And one of the best ones is by a guy named Ed Easterling. And what he showed is that once inflation expectations go above 4%, the forward return to stocks runs negative, right? So there is a threshold at which inflation begins to hurt stocks as well. Stocks are likely to outperform bonds, but cash outperforms both in real terms. And so that's something that we'll explore the next time we're on. Awesome. Thank you, everyone, for tuning in, and tune in next time for Money Sense.